There's no such thing as a free lunch, but YieldMax seems to be offering some of the highest yields I've ever seen. And that comes with a steep cost, of course, yet they've still managed to attract nearly $10 billion in assets under management, or AUM. Probably the most questions we get about ETFs surround the YieldMax product offerings. Is an 83% yield too good to be true? Are these YieldMax high yield ETFs the solution to your retirement planning gap woes? Let's find out now. I spent a decade working for MSTY, a leading provider of global indices that has probably the most cracked research team out there. In that capacity, I built teams from the ground up across multiple continents. Our mandate was to build and support products for the world's largest asset managers, broker-dealers, hedge funds, and sovereign wealth funds. As I used to tell our customer support teams all the time, always understand who you're talking to. Now, I'm an OG, so the first thing I wanted to understand is who exactly YieldMax is. When you go to their website in the About Us section, this isn't very fulfilling. It talks about meeting the team, and it's just a bunch of corporate entities. But when you drill into one in particular, which is Title Investments, you see the leadership there seems to be largely ex-Global X ETF guys. Now, we have a generally favorable impression of Global X ETF products in that when we do ETF comparisons, they usually come out on top. And when we look at the largest ETF providers out there, it's no surprise to see BlackRock and Vanguard at the top. But what I found interesting is to see the average cost of ETFs. Look how low Vanguard is now, under 10 basis points. That's remarkable. And I was quite surprised to see Charles Schwab getting down there at 12 basis points. That's very good. And then in 15th place, you'll see Global X. They've managed to amass quite a bit of assets under management now, so around $57 billion. And at 51 basis points, a lot of those ETFs aren't very cheap, but that's because they're either actively managed or some hybrid on active management. Now, when we look at Title, they refer to themselves as the ETF masters. They talk here about their award-winning full-service ETF platform. They manage 193 ETFs, and they're responsible for $30 billion in AUM. Well, when you look at the AUM of their own ETFs, the YieldMax brand here, you see this aggregated. They have nearly $10 billion in AUM on the YieldMax ETFs, so that's about 1/3 of all the ETFs they're managing. And the top 4 ETFs in the list surround some quite volatile stocks. So first of all, there's some numbers here which are of concern. You have an average cost of over 100 basis points. So I'm not paying 100 basis points for any ETF. I mean, there may be some alternative assets out there like startups, wine, or art that I'll make an exception for, but that's just a lot of money. The number one predictor of a fund's outperformance would be low fees. Now, the second bit of information here that's interesting is their 1-year return average for their ETFs, and certainly you need to compare that to a suitable benchmark, but the real alarming number here is this dividend yield of 48.45% on average across all their ETFs, which brings me to the single most important lesson I've learned in life, whether that's academically, professionally, in relationships, etc. There is no such thing as a free lunch, and that quote originated, they say, from pubs that used to offer free snacks with beers, and these snacks would have a high salt content, and the patrons would therefore order more beers. That holds true across everything in life. And people always want to try to find shortcuts. There are no shortcuts. And for any asset that generates income, always ask yourself where that income's coming from. Any asset can generate 10% income a year. You just sell 10% of it, right? This is really reminiscent of the new 4% rule that ensures you don't run out of money in retirement. That's something we covered before. But you always need to ask, where does this income come from? Now, when it comes to YieldMax, they're getting paid either way. They're bringing down about $100 million in fees right now. Contrast that to ARK at $91 million. So YieldMax is a very successful ETF franchise, but that doesn't mean their products are investable. Wall Street is not in the business of making you money. They're in the business of generating transactions. And when you look at how these income ETFs from YieldMax work, the ones based on a particular stock, as the top four are, you see there's really two strategies here. The first is a standard covered call strategy. The second is an opportunistic credit call spread strategy. Now, we're not going to get into the complexities of option strategies, which give you synthetic exposure to an asset. We're simply going to point here to this great table in their collateral that shows when they ought to be outperforming the underlying security. So if there's a slow rise in share price, they say they'll outperform, or a decline in share price. However, with significant price appreciation, as we're seeing with these names, they expect to significantly underperform the underlying security, which is indeed what's happening. Now, they say with low volatility, a slow rise in share price, in other words, they expect to outperform. Well, why not just start there to begin with? Well, no, because that's not what attracts the lemmings. And another thing to note here is that income will fall with lower volatility. So how does this match up to their slow rise in share price comment? Guess what? It doesn't matter, because these guys are going to get paid whether this vehicle outperforms or underperforms. Now, stocks as an asset class have appreciated around 9% a year since the earliest recorded data. So what you're going to do is go and try to find the periods of time where they temporarily underperform and then get exposure to that, and you're going to generate alpha that way. Good luck. You want downside protection? Diversify across asset classes like a normal person does. Vanguard lets you do this for under 10 basis points in many, many cases. And as I said, low fees are the biggest predictor of performance. So if we look at one of the most popular ETFs from YieldMax, this YieldMax NVDY Option Income Strategy ETF. Of course, it does not invest directly in NVIDIA. That's very important. I presume that probably most people that get drawn into these vehicles don't have a clue about what they're getting themselves into. Note that they explicitly tell you the fund strategy will cap its potential gains if NVIDIA's shares increase. Well, that's not a good thing, right? And of course, it says it's subjected to all potential losses if shares decrease in value, though the previous table, that's their caveat, the previous table suggested otherwise, though we would challenge that. They say, of course, too, that you're not entitled to any dividends paid by NVIDIA because NVIDIA does pay dividends, and that doesn't really matter here because, as I said, this is a synthetic, so you're not entitled to dividends anyways. Now, when you look at the payments page, this is where all the yield chasers start to get really excited. Well, when we look at the performance of any investment, we need to consider total return, which isn't just the income an asset pays, but also the appreciation of the asset over time. So when we look at all the history we have for this NVIDIA strategy ETF, it only goes as far back as May of 2023. But when we look at that performance, we see it's lost 8.45%. So what we need to then do is to take this performance and aggregate that with all the income and to see just how well this performed against the benchmark would be NVIDIA, right? Now, of course, we always say this short-term performance means next to nothing, but since this vehicle is designed to underperform, we can simply show you an example of that happening. And it's definitely working. It's underperforming. So when you consider these payments, we've plotted them out here. You can see how sporadic they are. So if you're relying on this asset for income, you better be used to a lot of volatility on that income. But if we do back of the napkin math here for performance, a starting value of $20 roughly, an ending value of $18, a total of $26.31 in dividends, you get $44.63. So a return of 123%. Now, first of all, that doesn't match the cumulative performance numbers from YieldMax. I suspect maybe they're doing dividend reinvestments there. I don't know why you would want to take this income and put it into an asset that keeps becoming eroded over time. But when they provide their performance numbers, you see here they're much larger, 164% monthly, 205% quarterly. It doesn't really matter though, because NVIDIA's returned 312% over the same time frame. You would have been better off just investing in NVIDIA, and that's as designed. This thing is expected to underperform the assets. Now, whatever reasoning they're going to use to try to justify the reason why an investor ought to invest in this vehicle, it will not compensate for the 1% expense ratio you're paying here. This is an asset that's an actively managed fund that generates monthly income by selling, writing call options on NVIDIA. You know what they say about actively managed funds? We covered that recently. 95% of active managers can't beat their benchmark in the long run. That's a fact based on a study by S&P Global. They explicitly state for this ETF that you're going to receive capped participation in the price gains of NVIDIA. Why the hell would I want to cap that? This makes no sense at all. You're better off just investing in NVIDIA. Here, a very concerning statement: YieldMax ETF distributions may contain return of capital, but an estimate cannot be provided at this time. I'm sorry. Don't take my money, trim 1% off the top, then hand it back to me and call it a yield. What happens when volatility decreases surrounding NVIDIA? What's that going to do to this income? So always focus on total return. Selling call options on stocks you're bullish on is a very bad idea. Shorting or trying to predict when the market's going to fall is speculating on a trend that's going against you over time. When quality companies decline in price, that's when you should be adding them. So capping the upside for any great growth story, especially one you believe in, is a really bad idea. You may say, well, I'm bearish on NVIDIA. Fine. There's a lot better ways to play that thesis. And just remember that if your reasons for being bearish are because you're trying to time the market based on valuations, trying to time the market successfully over time rarely works out. The limited performance we've looked at for this one ETF shows us that it's better to just invest in the core asset. Now, people will look at this cursory look at the tin and say, well, I can invest in NVIDIA and make 48% yield at the same time. That's the sort of rubbish that instant analysts out there are peddling. And when you look at all the ETFs offered by YieldMax, you see here this covered call ETF section. There's all kinds of names there. And when we look at their largest ETFs, we can start going down the list. You have the biggest four. They have all with $1 billion in AUM or more. These are option income strategies on MicroStrategy, NVIDIA, Tesla, and Coinbase. All of these are designed to underperform the asset they're based on. That's as designed, everyone. Then we jump to several fund of funds. This is a basket of these other ETFs that's charging 1.28% on top of the underlying fees of the others. Pass. Now we're back to option income strategies. There's nothing here we would remotely be interested in, even by accident. Now these lads are doing a great job of attracting AUM. It doesn't mean their products are good investments. Welcome to Wall Street. So just some closing thoughts here. Don't bother doing the mental gymnastics needed to try and justify this. Some people desperately want to believe they've found a free lunch and they will aggressively argue against the facts presented in front of them. Fair enough. There's a sucker born every minute. Paying an active manager 1% is probably one of the biggest mistakes we see investors making. Active management is dying, as we pointed out in our previous piece on T. Rowe and Ben. However, it's died before, and you'll always be able to convince people, as YieldMax shows us, to spend quite a bit of money on expense ratios for products that won't outperform the market. Building wealth is a long, slow, boring, and largely predictable process. Stop trying to shortcut that process. You'll be on your path to wealth a lot sooner, which means a lot more money, because the earlier you get started investing competently, the more money that you're going to have in your retirement. So I'm going to go ahead and leave you with another video on a hugely popular ETF out there. This is also a covered call strategy ETF with $38 billion in AUM in this ETF alone. Give that a watch. Thanks so much for taking the time to watch this today.